Hello everybody, welcome back to my channel. So CapitaLand Integrated Commercial Trust or CICT just released the first half 2022 results and I'm here to talk about it. I thought the results were kind of expected, nothing really surprising. So I say it's like a steady ship and steady as she goes. But I'm actually looking out for something else not within the presentation, not within the numbers. So let's briefly go through the numbers for just a little bit of surprises here and there. And at the end of this video, I'll talk about what is the main other thing I'm looking out for. So let's get started. So the DPU front, well, it's an improvement on a year-on-year basis. So 5.18 for the first half last year and 5.22. So improving metrics, nice to see. But this is what you expect as well, right? Of Singapore's reopening. So malls are probably gonna do a little bit better, and offices are quite strong as well. So it's not surprising, of course, that the DPU is slightly higher. So operational highlights, again, nothing that surprising at all. I find this number really kind of took me by surprise. 8.5% rental reversion for the offices for the first half 22. So that's quite strong performance, isn't it? But this is quite in line with other office plays results. So especially Capo REIT, right? So if you look at the other video I made on Capo REIT's results, you can see very robust Singapore office performances as well. So this is reflected in this REIT as well. So for the retail front, well, things are getting better. Sales are up for the tenants. Shopper traffic is up as well. But unfortunately, those improved numbers did not really translate into rental reversions. So if you look at it, suburban malls are flattish or kind of a little bit higher, but downtown malls are still down, negative reversions, and that's a sure sign, right, that it's really suffering from a lack of tourists, visitations, shoppers from other countries, like especially China, right? So this is still suffering. The suburban malls performance is probably still a sign of a reluctance of tenants to expand, especially in view of the inflationary environment that we're in right now, right? Where everything is expensive, labor is crazily high, raw materials like oil, meat, eggs, everything's up, right? So I think tenants are in a cautious mood, and this is reflected in their rental reversion numbers. So on a portfolio basis, it's still down. So the good improvement in sales and traffic, shoppers traffic, did not really filter down to the rental reversions. So the bright spot for this portfolio, of course, is after the merger of CMT and CCT, we now have an office portfolio, and this segment is actually looking pretty good. So the key metric to look at is this number here. So the average rent that are expiring in 2022 for the portfolio is 1119. So over here, the average is 1119, and the market rent right now for Grade A offices is 11.3, right? So this one is higher than this one, right? So it's looking like if they manage to uh, renew the leases, they should be able to get some lift in the office leases. So from 1119 to something around 1130, right? So quite marginal for 2022. But it's going to be quite significant though in 2023 and 2024. So in 2023, the average expiring rent is 1113, and 24 is 1083, right? So this was leased during the down cycle a few years back, right? Because remember the office segment is always kind of cyclical. I remember the magic number to look at is 1130, right, which is the current market rent. So this rent is quite significantly higher than this rent, right? So if the office dynamics continues for the next 1 year, 2 year, 3 year, we're gonna have a more decent uplift in the office rental income. So, but of course, all this depends on the economy, right? And whether or not a recession is really gonna come, whatnot. But the office demand seems quite strong right now, which is quite reflective of Singapore's status as a safe haven, right? Amidst geopolitical woes and volatility in the global markets. So I think Singapore is still quite a safe haven that people want to come here and set up business. So a bit of a bright spot over here. But this is the interest rate hikes that everybody know is happening and occupying markets. Well, this looks like a pretty well managed balance sheet. Leverage is kind of high at 40%, but the other metrics are pretty well. Look at the percentage of borrowings on fixed rates. It's 80%. So it's pretty well shielded. And if you look at the debt maturity, only 18% are up for renewal for the next 2 years. So they actually give us a sensitivity analysis. So if you have a 1% increment in rates, actually the DPU impact is just a 0.28. That's versus a 10 cent DPU, right? On an annual basis. So the impact is actually pretty marginal. Nothing that crazy to be worried about. Um, but of course, a lot depends on the profile of the interest rate hikes, right? So if you look at it, we are one day after the famous FOMC, so the famous day after. So Jerome Powell raised by 75 basis points. So the Fed fund rate is now 225 to 250. So if you look at projections in the markets, so this is a projections from February 23, right? So something like 6 months away. The consensus is kind of centering around a 3.5% Fed funds rate. So a bit of an adjustment here and there. But I think the standard is around 3.5. So meaning to say, from now to 6 months later, market is expecting something like 75 basis points to 1% rise still. So, well, if the Fed is gonna keep raising rates, then the refi of the following blocks over here, what's gonna be the interest rate that they refi at? So I think the trajectory of Fed actions will still matter quite a fair bit, especially given that they have sizable refi chunks over here. But of course, it's quite hard to predict what the Fed's gonna do because they're raising rates to combat inflation, right? And inflation is basically because of oil, right? And oil is basically because of the war in Ukraine and Russia, right? So if you want to project interest rates, you have to then project inflation, which then means you have to project oil and maybe raw materials like wheat, which of course depends on the situation in Ukraine, which means you have to project the actions of Vladimir Putin in Russia, and that's pretty much impossible to do, right? So it's a bit of a anyone's guess here. But finally, this is of course the thing that I was talking about, which is the other thing that I'm looking at other than the financial metrics, which is the huge portfolio that NTUC has put up for sale in their 4 billion shopping mall portfolio. So this is quite a very decent portfolio of Jurong Point, Ang Mo Kio Hub, Next, and a Thomson Plaza. So NTUC is selling this stuff, total size of 4 billion, and it's rumored reported by the Business Times. So this is a Business Times article. The CapitaLand and LinkREIT are paying for it. Actually, it's a CICT over here, CapitaLand Integrated Commercial Trust. Well, I think the possibilities are few. One contender is of course LinkREIT from Hong Kong, a very big and well managed REIT in Hong Kong. One possibility is for CICT to take on the portfolio on its own, but actually it's quite a big portfolio. It's 4 billion. So another possibility might be for CICT to team up with its sponsor, meaning CapitaLand Invest, and jointly do a JV or something and bid for this portfolio. So it's hard to say who will win ultimately because it depends on how high the bidders are willing to pay for this portfolio, which is a pretty good quality portfolio. But of course, if CICT eventually ends up winning the bid, either on an individual basis or as a JV basis with its parents or whatever form it takes, then the question is, of course, how do they fund it? Is it going to be through debt, perps, or maybe an equity raising exercise? So I guess the market will be closely watching the details of this deal, which can affect a lot of the matters, right? Especially if it involves an equity raising. So that's something to watch out for. So we've reached the end of this video. Thank you for watching so far. If you like what you saw, remember to subscribe over here, like, share, and comment. So see you soon.